It is a pleasure to be at this very interesting conference with you today. And it is, of course, a pleasure to introduce our next speaker, Daron Acemoglu, a professor of economics at MIT, who will be speaking on corporate responsibility in the age of automation, inequality, and climate change. Daron, welcome, and the floor is yours.
It's my pleasure to be here with all of you. And as Lucrezia mentioned, I'm going to talk about corporate responsibility in the age of automation, inequality, and climate change. If you look at newspapers or listen to people making pronouncements in public forums such as Davos, corporate responsibility is all the rage today. You'll see Facebook advertising its commitment to new internet regulations, Philip Morris talking about making smoking history, and many of the big oil companies announcing plans to reduce greenhouse emissions. Many view this as a rethink of the shareholder values revolution and perhaps the beginning of a new age of corporate responsibility. Well, in my opinion, I don't think so. I think we are in the midst of very severe challenges facing the world, both economic and social. And we need fundamental restructuring of our institutions. And I worry that current proposals for corporate responsibility are not much more than empowering already existing CEOs, and they're not really coming to grips with existing challenges. To make this case, I'm going to focus on two of those that I have worked on and I think are particularly important: inequality and climate change. Let me jump into it without further ado and talk about inequality first. And I'm going to focus on the US first, but talk about other countries briefly in passing. Well, I think this figure tells where the origins of the inequality problem or labor market problems in general are. On the left, what I'm showing is the evolution of wage bill in the US over the 4 decades following World War II. And what you see is that in real terms, wage bill, how much private sector was paying to workers, grew very steadily, both because employment kept growing, but even more importantly, wages per worker kept growing. And overall, we have about a 2.5 percentage points faster growth in real wage bill than population. But on the right, over the last 30 years, you see a slowdown in the wage bill and then a flattening out. The private sector is not paying much more today to workers than it used to do at the beginning of the 2000s. This has had various sweeping consequences. The fall in the labor share is one of those, but even more importantly, it is intimately linked to the huge increase in inequality in the US. So these two charts provide a summary of those inequality trends. They show the real weekly wages for 10 demographic groups, men, women, all the way from high school dropouts with the dark red for both groups, all the way up to workers with postgraduate degrees in dark blue. You see that in the 60s and early 70s, and the same is true in the 1950s, those 10 demographic groups had broadly shared prosperity. Their real wages were growing in tandem. But since the early 1980s, you see a very different pattern. Workers with postgraduate degrees are continuing to enjoy rapid wage growth, but even workers or men with just a college degree, the light blue on the left, is experiencing stagnation, and workers with lower education, such as the orange and the red lines, are experiencing quite significant declines in wages. This is a phenomenal increase in inequality, and it's not just an increase in inequality, it's some groups losing out quite significantly while the rest are continuing to flourish. This pattern has some US idiosyncratic aspects, such as the bottom of the wage distribution falling out, but the overall increase in inequality is not just a US phenomenon. If you look at most OECD countries, they were not as unequal as the United States in the labor market, but most of them experienced increases in inequality, here shown with the Gini coefficient, and in some cases, including some of the Nordic countries and the UK, almost as large as the US. More telling is the form that this inequality and labor market changes have taken. And here again, comparing the US to several other countries, you see a very strong parallel that all of these labor market trends have been associated with middle class jobs disappearing. And here, the way I'm showing that is dividing employment in every country into bottom, middle, and top tercile of occupations in terms of quality or wage. And the middle includes blue collar occupation, clerical functions, retail, sales, office work, operators, and so on. And these used to be the jobs that were the bedrock of middle class and upward mobility. And what you see is that in all of these countries, these jobs have been disappearing. The red bars are all heading or pointing to the south. Now, such a complex phenomenon, increasing inequality that's gone on in many countries, the middle class jobs disappearing, a slowdown in labor market growth, these are bound to have many explanations, from globalization to changes in institutions. But my own work points out to the importance of automation. And in fact, you can think that automation is important already from the previous chart, because what distinguishes all of those middle class jobs is that those were exactly the ones that were at the crosshairs of automation. For office jobs based on specialized software such as databases or accounting software, and for operator and blue collar jobs based on dedicated machinery, numerical control, and over the last 25 years or so, industrial robotics. And in fact, if you look at the effects of technology, you really see this twist towards automation. And there, I would like to preface this by saying that if you want to think about technology, the way that most economists used to do is to think of technology as something, increasing labor productivity. And of course, when it increases labor productivity, it's pretty natural that it's going to have a almost automatically positive effect on wages. But in fact, it is very important to distinguish different types of technologies. And it is critical that some technologies, such as automation, substitute machines or algorithms for jobs, tasks previously performed by labor, while other technologies enrich the possibilities for labor by creating new tasks or increasing worker productivity in some of the tasks they used to perform. So here, again, for the US economy, for two sub-periods, I'm giving a decomposition of different types of technologies classified into automation technologies that displace workers versus others, such as new tasks that reinstate labor into the production process. And what you see on the left is that there was very rapid automation, as shown by the dashed line. But it was completely counterbalanced by other technological changes that neutralized the potentially negative effects, for example, on labor share that these automation technologies would have. So as a result, the sum of the two, the thick blue line, is hovering around zero. That's the neutral effect of technology. But now fast forward to the last 30 years, and you see a completely different pattern: faster automation and much slower changes in other types of technologies. And as a result, now the blue line is heading south, explaining much of the slowdown in in wage bill growth that I showed you earlier. Now, this is, of course, a little abstract because it's across many sectors, different types of technologies. So let's zero in on a specific type of automation technology, industrial robotics, that's actually been probably the most productive use of automation technologies over the last 3 decades or so, because many industries have been revolutionized and productivity increased significantly thanks to industrial robots. So if the sunnier interpretation of what technology does, that it creates broadly shared gains both for capital and labor, then you would expect that places that introduce more robots should also have better outcomes for workers. So this chart looks into this question across different local labor markets in the US defined by 722 commuting zones. And what you see is a strikingly strong negative relationship between industrial robotics activity and employment. The same is true if you look at wages, and the same is true if you look at inequality. Inequality increases as well. The places led by the industrial heartland of the United States, places such as Detroit, Lansing, Cleveland, but not confined to them, you see that when there are more industrial robots adopted, employment declines, wages decline, and so on. Of course, robots at some level are the technology of yesterday, the technology of tomorrow or even today is artificial intelligence. As a broad technological platform, artificial intelligence could do many things, and several commentators think that AI is going to revolutionize many industries by creating a lot of new possibilities for firms and workers. But my recent work with Pascual Restrepo, Joe Hazel, and David Otter shows that AI has also gone in the direction of more automation. So here, using various different measures, what I'm showing is that the establishments that have adopted AI technologies have been exactly those that have more replaceable tasks. And even more strikingly, if you look at those same quartiles of the distribution for the green and the blue, and look at what they're doing in terms of hiring, they are exactly the ones that have stopped hiring, whereas the rest of the establishments, those that are not adopting AI, have continued to grow their hiring and employment. So again, that shows that although we are very much at the beginning of the AI process, and AI could be used for many different things, it looks like it's going more in the automation direction. So hence, likely to deepen the trends that I have shown already. Now, at this point, some people might say, well, tough luck. This is the future of technology. In the words of founding editor of the Wired magazine, this is what technology wants. Who are we to debate what technology wants? Well, I'll take exception to that. First of all, contrary to what you hear from Silicon Valley or the biggest enthusiasts of these technologies, we are not getting much productivity dividends from these new digital technologies. In fact, if you look at the measure of the most common measure that economists use, total factor productivity growth, the last several decades have been the slowest total factor productivity growth time since the beginning of the 20th century, despite the fact that we have a bewildering array of new digital technologies, AI products, and all sorts of other automated products being introduced. Instead, it looks like there are many sectors in which automation has run into dead ends, and my argument would be that, in fact, that is because we are not investing enough in other technologies that would boost worker productivity, boost worker opportunities. There are many reasons why there is excessive automation. Competition with Japan and China has shifted firms towards cost cutting. Tax policy in the US and in many other OECD economies actually encourages automation because it subsidizes capital investments while taxing labor, for example, by income taxes and payroll taxes. But also central is actually the effects of Silicon Valley companies whose business model is based on algorithmic automation. These companies have not only become the largest in terms of stock market value and contribution to GDP, but they are influencing pretty much every other sector in terms of their technology choices. And crucially, the COVID crisis is deepening all of these things. Many companies are going more and more in the automation direction. There is nothing unethical about automation. Of course, automation has been going on since the beginning of the Industrial Revolution with the spinning and weaving machines. And automation, as I showed you, was fast in the 4 decades following World War II, and it was also fast, for example, with the mechanization of agriculture before World War II as well. But what we are doing is excessive automation. Technologies that we adopt and develop are choices. And because of the business models of tech companies, venture capital business model, and also government inducement, we have gone too much into automation, ignoring other technologies that would have improved productivity and, more importantly, would have had different distributional effects, different opportunities. So it is critical that we have to recognize the direction of technology is a choice. It's a choice that companies make, but it's a choice that society and governments have to have a say in it as well, which brings me to the issue of regulation of technology. So what we are seeing here, therefore, is the first point that I want to make in regards to the corporate responsibility. We have to recognize that technology choices, especially when they are at the stage of deciding the technology paradigms and broad approaches, have a variety of societal implications. And it's not clear that existing models of corporate responsibility with firms interested in their shareholders, interested in their CEOs' aggrandizement or pay, and exactly trapped with a particular way of approaching a problem, for example, how to best use digital technologies, are necessarily making the right choices. So therefore, here we have to think about how society, including government policy, can push companies towards different uses of technology that will be more beneficial. Not just automation, but what we see here, machines and humans working together. The same topics, the same themes you can see in the area of climate change. We are just finishing COP26, so I don't need to tell people about the urgency of the climate challenge, but perhaps this figure is not as well understood as people should recognize. Today, solar, bioenergy, and wind are actually cost competitive with fossil fuels. If you remove fossil fuel subsidies, which are estimated by some to be in the range of about $5 trillion globally, in fact, they would be cheaper in most tasks, not in heavy fuels, but in most tasks than fossil fuels. But we are not making enough of a switch to renewables. That's one important point. But the second important point is actually how we got here. If you look at the cost of, for example, solar, even as recently as the late 2000s, solar was prohibitively expensive. We've had tremendous technological progress in renewables, wind and solar especially. And this was not thanks to large companies with their true or just for show corporate responsibility. It was rather because of a variety of new innovations, learning by doing by smaller producers with government policy. Subsidies were very important, and government regulation in Europe and at the state level in the United States. And also, pressure from consumers was very important for generating some of this switch. But in fact, the story is even more interesting. And to show you that, let me plot what's happened to innovation in renewables. So here I'm showing 4 measures of renewable or green technology patents relative to either fossil fuel patents or all patents. And in all cases, you see exactly the equivalent of where that cost declines in wind and solar were coming from. From beginning of 2000 to around 2010, you had a huge turnaround, an increase in these patents. This was the era of renewable innovation. And again, this wasn't the large companies. But then what happens? After 2010, you see exactly a reversal. Where is this reversal coming from? Well, this is not a US phenomenon again. If you look at other countries, Canada, Germany, France, you see exactly the same pattern. And in fact, this reversal is a global trend, and it is caused by the energy sector, shale gas, and other gas use and extraction increasing, which led to a significant decline in gas prices. And together with gas prices, the gas share of fuels has increased. And this has dislocated renewables. And more importantly, it has reduced renewable innovation incentives. And you can see that, for example, here, I'm showing again the green to fossil fuel patents in the US by the blue line. And with the red, I'm showing what's going on with the natural gas price index. So exactly the same pattern in the two of them, and it's not too much of an imagination to say that the two are causally related. What's going on here is exactly that the energy sector, while touting its green credentials, has been investing so much in natural gas and shale gas that it has completely stopped the most promising part of the transition to green energy. And again, we see the same thing. Corporate responsibility, whatever CEOs say, is not to be believed. At the end of the day, CEOs are working either for their shareholders, sometimes just for their own aggrandizement, or sometimes for both. But I think this is no longer good enough. In the language that James Robinson and I introduced in our book, Why Nations Fail, we are going through a critical juncture. There are major threats to the existing order There is a need for reform, and I think it's broadly recognized, but there is no clear path of exactly what that reform will go. There's a lot of agency, there's a lot of contingency, and we really need to find a new way. Throughout most of the history, the main barrier that you have to work against was the excessive powers of elites via coercion and control of key assets. Today, I think we are seeing related but quite distinct challenges creating this critical juncture. Again, I will confine myself to climate change and inequality. What we are seeing is labor market, which is where most of people have their opportunities, being destroyed by excessive automation, and this creating a two-tier society. And then we are also seeing the usual industrialization dynamics, which was often useful for increasing GDP, bringing huge amounts of environmental damages, especially with climate change. So both of those require new institutional frameworks, but together with those institutional frameworks, you really require different approaches and different incentives and different responsibilities for corporations. Institutions are no good unless you have buy-in from corporations, because at the end of the day, new technologies are going to be developed by corporations. They're going to be implemented by corporations. Energy is going to be produced by them. Labor is going to be hired by them. So what we need is really rebuild inclusive institutions, but differently from the past, where reducing coercion, creating equal opportunity, creating a level playing field, and enforcing basic property rights and security for most players was enough. Today, I think inclusive institutions will have to have a major element of regulation of technology. Now, that might at first seem quite dangerous, counterproductive, because after all, innovation is the lifeblood of modern market economies, and who is it that the government or bureaucrats should come and regulate technology? But both areas that I emphasize as critical highlight that regulation of technology is vital. If we don't regulate technology, existing corporate structures are going to go more and more into automation, creating this two-tiered society. And if we don't regulate technology, green innovation is going to fall behind and insufficient. And this cannot be done alone, as I said, but it's also naive to expect miraculous corporate responsibility unless it is forced. And I think this is where we need two pillars of forcing corporations. First of all, it has to be government regulation, but second is societal pressure. It is also a figment of imagination, I think, in sometimes in business schools, sometimes in media, that corporations exist separate from the rest of the stakeholders. And I think the rest of the stakeholders includes their workers, but includes broader society. For example, when we are talking of environmental issues. And I think there is no way that any organization will serve their stakeholders unless they get the signals about what is the interests and what are the priorities of those stakeholders. And the best way of doing that, the only way of doing that, is societal pressure. This works sometimes through employees, sometimes through consumers, but I think it has to find other pathways in order for us to rise to these new challenges and rebuild inclusive institutions. Let me stop here, and I look forward to your comments and questions.
Thank you, Daron. I will just few questions already coming. So we have a question from Angela Polk from Columbia University, who is interested on how you see or whether you have considered the employee and broader demographic area on an urban versus rural basis within the US and elsewhere. Well, her assumption is that, particularly in the US, rural, particularly in the South, is agrarian and not only more exposed to climate change, but also for the manufacturing business, there are no unions or alternative business options.
Well, there are many issues here that are being raised. Thank you very much for doing that. I haven't worked on this myself directly, but some of my work touches on it. Indeed, there are big differences regionally within the US and also within Europe. During the same period, economic gravity has been shifting very strongly towards coastal areas. And that has several reasons. One of them is that many of these big companies are located in coastal areas, but also some of the industries that have declined because of globalization and automation used to be in the what are sometimes called the flyover country, the sort of inside of the country. And I think, it's, of course, many factors are playing a role. The fact that unions are weaker in the South has played some role as well. But I think the broader issue here is indeed that, if you look at the earlier era, companies that were at the cutting edge, such as General Motors, employed, millions of workers, and quite broadly across the United States. They weren't all in New York or San Francisco. Today, if you look at Google, it's much bigger in terms of its contribution to GDP than General Motors, but it employs less than a tenth of the number of workers that General Motors employs, and they're all concentrated in a very few local areas. So I think that again speaks to this broader issue of whether we have the right technological portfolio, whether it's balanced, and whether we're investing in the communities and the workers as they are, with their own given skills, with their own given locations. And I think there are failures there that we have to take into account in the context of what I've just talked about.
Daron, I have a question coming from myself. You haven't emphasized the role of investors. I mean, you talk about corporations, and I have some sympathy with what you say about regulations. But we are in a global capital market, so these kind of public policies are national, while we need global answers. And the investors have a role to play. And in the field of climate, there is quite a lot of evidence that investors are shifting their preference and putting the money, into the good stuff. Okay, there is maybe some ambiguity on those on that evidence, but there is some evidence in that direction. And there is a lot that you can do in terms of developing standards, private and public partnerships, and so on. So, what do you think of that view of?
Well, I think, Lucrezia, you're raising two separate issues that are both very, very important. One of them is the global nature of it, which I think raises a lot of challenges because redirecting technological change in one country is not possible. It's the investors and it's also the consumers in other countries. So how do you redirect technological change in the US when China and India are not investing in green technologies? So I think that's a very important thing. There, we really have to talk about other issues of the day, such as global cooperation, global institutions. But again, I think there are things that can be done. US and European Union are still technologically at the forefront, and if they lead, some other countries will be more likely to follow. The second is whether investment incentives are enough. Well, in principle, there could be. I emphasize, for example, employees. Employees put a lot of pressure on their companies in order to reduce their carbon footprints, and consumers have been at the forefront. The boom in electric vehicles, for example, is partly because there were subsidies. Tesla was the biggest receiver of subsidies, partly because countries like Norway, for example, are providing huge subsidies not just for research but also for consumption of electric vehicles, but also because consumers really care about it. However, my own assessment is that while I think consumers have had some impact, investors haven't. Indeed, there are investors who care about investing, quote unquote, ethically, but there is so much money out there that doesn't. That at the end, the balance is not really working out. So if you look at over the last 10 years, for example, the amount of money that's gone to fossil fuel companies is larger than what's gone to renewables by an order. And as those charts that I showed, in fact, it was a lot of this investment in natural gas, shale, that really scuppered the more successful efforts for innovation towards green technologies. So I wouldn't hold my breath that investors, and in fact, I think one area of investment, venture capital, has consistently gone in the direction of excessive automation and also wherever higher profits are, regardless of its societal consequences. So I'm not sure. Perhaps in the next decade, different vehicles and different organizations in the investment side can emerge that will change this balance. But I wouldn't hold my breath yet.
Okay, thank you. I have a question from Anna. A lot of green technology innovation is happening at fossil fuel companies. They're cash rich, so very well positioned to lead the green energy innovation. So how should we provide incentives to oil and gas companies to invest more in green energy innovation?
Yeah, I think that's a very, very good question. I don't know the answer to that because, the main issue is if you look at today, that's indeed true. If you look at the 2000s, that's not true. And into 2000s, we saw a lot of solar, wind, biofuels, and other sort of technologies that came out of big oil. But today, big oil has moved into that space, and I think it's for two reasons. First of all, it's because that's where the subsidies are and they want to grab the subsidies. And second is greenwashing. Now, the fact that they are getting into it for exactly the wrong reasons doesn't mean that it won't be effective. They do indeed, exactly like you say, Anna, have greater resources, and those resources might mean that despite their cynical attitudes, they may be the ones that actually make more progress in green technologies. But at the end of the day, I find that hard to believe because still the majority of their profits are coming from fossil fuel. In the case of Koch Industries, it's going to come from coal. In the case of ExxonMobil, it's going to come from oil. So there is the usual RO replacement effect. They will be self-cannibalizing when they uh, push green technologies forward. That's one of the things that economics of innovation has understood since the 1960s. So I think it will be much healthier uh, if other companies were innovating and replacing and taking market share away from them. But I don't know. Everybody will have their own assessment of the success or failure of Glasgow. But I think Glasgow has seen the big oil and big energy sort of taking over this agenda. So it worries me. I'm not saying it will be disastrous, but there are, I think, a lot of reasons to worry about these companies and their so far very unscrupulous CEOs really leading the charge for combating climate change.
I have a question from Hilmar Eggertsson from LBS, who is a big fan of all your work. Okay, so that's the introduction to his question. And the question is as follows: do you believe that there will be divergent of the definition of shareholder values depending on which jurisdiction market you operate in? And more pressures to avoid simply looking at profit in the US, in the EU, and integrate other standards to define value, while other places will still look at shareholder value from our historical definition?
Yes, I think that's a great question, and indeed, I think there will be a lot of heterogeneity in the decades to come. With the Business Roundtable and other influential business organizations saying, this is the end of shareholder values, I think there will be different models competing and different ways of sort of assessing things. And I think that's both an opportunity and a danger. The danger is that my concern is that some of these will just empower CEOs. CEOs will decide what is the right thing in the interest of broader stakeholders, especially if we don't define what those stakeholders are. And I think the whole process would go wrong if it's not complemented by a robust regulatory framework. So that's why my sort of emphasis has been on both regulation and corporate responsibility coming with societal pressure and broad things, because I think the two are complementary. But exactly like you say, the global dimension really complicates it. And exactly who are the shareholders, who are the stakeholders. I think one thing that might help there is, again, the recent, something that the OECD has been pushing for more than a decade, but now the Biden administration took up, which is a global minimum capital tax. And that makes sure that profits of large conglomerates are banked in a clear way and they're not shifted across jurisdictions. That would actually really complicate this issue of who are the shareholders and where the profits are being realized. And I think that will be another complementary step if it can be done in an appropriate way.
What about, that's a question from Klaus Leonhardt from DXC Technology. Can't we solve the problem with automation by taxing companies based on revenues per head?
That's a very interesting question. So, my thinking so far is that we do not have the right measurement framework for taxing automation or using fiscal tools for discouraging automation yet. So if you think of the climate change, the first step that really was the beginning of everything else was a measurement framework. we decided that the right metric was carbon, emission of carbon. So that made carbon tax feasible in many countries in Europe. We now have a carbon tax thanks to that. So I think we need to develop a similar measurement framework of what are the aspects of technologies that are more distributionally advantageous versus excessively automating. And I don't think we are there yet. So I would not be in favor of robot taxes or things like that at the moment. But I think before we get there, there's a lot that can be done that would get rid of existing distortions that encourage excessive automation. So, for example, right now in the US, and other people are doing similar studies now for other countries, and US is a bit extreme, but not an outlier, complete outlier. In the US, the government pays an effective 20% subsidy when you hire machines instead of workers, because workers are taxed at the margin by 25%, whereas machines, especially automation machines, are taxed at less than 5%. So that creates a mighty incentive to use machines to automate work rather than hire workers. So if we get rid of that by standardizing capital and labor taxation, that would go a huge way. Now, economists, of course, for a long time have been in favor of low taxes on capital. We can get into that, but I think that was an incorrect assessment on the part of economists. But leaving that aside, I think the first step would be to have a more symmetric treatment of capital and labor in the tax code, and that would go a long way. And then we can see with other things like subsidies and greater diversity of approaches to technology, perhaps that will take us most of the way towards less excessive automation. And if not, then exactly the kinds of things that you are discussing would come into the foray. I think looking at labor share implications of new technologies would be one way of doing, but there are many other proposals one could consider.
Okay, we have 1 minute for a last question, bringing us back to inequality. A question from Lars Wolf from Ernst & Young. Does it take a huge economic crisis to reduce inequality? And which countries are leading on the effort to reverse inequality?
Well, it's a great question. And I think there are different approaches there. The historian Walter Scheidel, for example, argues that you take something of the order of the four horsemen of the apocalypse that would be required for changing inequality trends: war, huge epidemics, population collapses, etc. I don't think that's right, and I think the best example actually comes from the European welfare state, starting in the 1930s in Sweden and Norway, and then Britain in the 1940s. You had welfare state institutions that really leveled the playing field and reduced inequality hugely, brought macroeconomic regulatory framework based on Keynesian policies and so on, and those were triggered by some crisis situations like the Great Depression, but they weren't the kinds of crisis that Walter Scheidel is talking about. And certainly the pandemic today acting as a wake-up call would be consistent with trying to do something like the welfare state. At the moment, I don't think any country has found the formula that's going to be useful for creating the next stage of welfare states. Inequality is increasing very strongly in Nordic countries, but I think countries like Germany and Scandinavia have unique institutional advantages. Better communication between workers and companies, more coordinated wage setting arrangements that might actually enable them to be innovators in the institutional front.
Thank you very much, Daron. Unfortunately, our time is over. It was a great pleasure to have you here. Very interesting and food for thought.